All right, everybody. I'm just going to give people a few minutes to get into the webinar, and then we will get started. All right, we're going to go ahead and get started. What we're going to talk about today is Will Davis is going to tell us a little bit about the capital markets overlook that Alliance Bernstein has put together for us. One of the interesting things we've been hearing a lot from clients is what is going on with the economy. So hopefully Will be able to help us answer those questions. Fun note, we in our pre-meeting prep as we were setting everything up, Will and I realized that we were at the same football game in Tennessee 2 years ago, and it's the only one I've been to. I was watching my brother play and he was there for the other team. So fun little anecdote to get started. Will, take it away.
Absolutely. Well, Kara, appreciate you having me this morning and delighted to be here with everybody. It is funny. It's sad to say I was there cheering for the bad guys. Kara was cheering on the good guys, but unfortunately, I think the bad guys got their way that night. But that's 2 years in the past. We won't bring it back up today. I'm going to go ahead and share my screen just to make sure everybody can see it loud and clear. Is that coming through all right? Awesome. Well, as Kara said, my name is Will Davis. I'm a vice president and regional manager with Alliance Bernstein. If you're not familiar with the name Alliance Bernstein, we are an asset management company headquartered out of Nashville, Tennessee. So if you're ever in Nashville, especially if you're enjoying a drink on a Broadway rooftop, if you look up at the skyline, you'll see our name right there. Just know that when you see that kind of funny looking long name, we manage investments from stocks to bonds and everything in between. So with our time here today, really excited to dig into a little bit of the content that we've been seeing so far this year. Now, I am no stranger to the fact that we will be hitting the weekend here in right about 5 hours. And I certainly don't want to stand between anybody and that kind of feeling of freedom that a beautiful Friday afternoon brings. So with our time here today, I really want to address three key things. It's going to be one, let's talk a little bit about the volatility that we've seen so far this year before moving into why we've seen that volatility. When I speak about why we've seen that volatility, I really want to focus in on what the slide says here. It's tariffs, taxes, and policy changes, and most importantly, how that's going to affect Americans like you and I. And then to close out our time, want to share a few thoughts on just where we are with markets today and where we've seen some of these kind of policy tidbits start to bring opportunities to capital markets. So let me get mine. So to start off, I really want to talk about Q1 and Q2 of this year because it really gave us the tale of two markets that we've seen. If we start back to Q1, you can see that kind of from the left-hand side to the middle of that chart, it's not necessarily a positive outlook. The stock price of the S&P 500, which is that blue line, incrementally moved lower throughout the quarter. That's because as we had the current administration come in, who had forecasted changes to policy, both domestic policy, think taxes, as well as trade policy, think tariffs, the market started to get a little bit of pause. That's because what they had known for the previous administration was going to change, and they needed to reevaluate what was in their portfolios and really the stocks that they held. Right? That kind of not worry, but not overly cautious feeling persisted throughout Q1, right up to what we call Liberation Day, that first week of April. That's when the current administration came out and made the big announcement of reciprocal tariffs, right? We were going to start charging tariffs to companies that charge tariffs to us. But the way that that was communicated brought such shock and awe to the markets that we like to joke that Liberation Day was essentially liberating us from the positive equity returns that we had seen. Now, that lasted for about a week until we got the infamous Trump tweet of tariffs are paused. We're going to reevaluate this again in 90 to 120 days. Now, what I really want to emphasize is that every single text box on this slide is a tariff announcement. That is what really drove volatility through Q1 and then into Q2. But because of the pause that we had mentioned, the Q2 volatility that we saw was actually a little bit more positive. That persisted into Q3. This black line here is just once again showing the S&P 500's price chart throughout the third quarter that just ended a couple weeks ago. What we saw, though, that drove returns third quarter was not the uncertainty around tariffs, but now the knowledge that tariffs were going to be in place, and then the realization that the outcome of tariffs hasn't been as bad as what the market initially thought. What I mean by that is that you really haven't seen any meaningful fallout in broader economic data. GDP, or really a gauge of how the economy is growing, has stayed pretty strong. And inflation, a gauge of what prices will be, really hasn't gotten out of hand. So what that has meant is that companies and investors felt a little bit more comfortable, I should say, taking on risk. And that's exactly what they did throughout Q3, right? They drove prices higher because of that more comfortable footing coming off of the Q1 and Q2 uncertainty that we'd seen. Now, what I really want to dive into as far as a policy standpoint is concerned, that kind of aforementioned volatility from Q1, is what does it mean to you and I, to the average American? Well, there's a few key considerations in the One Big Beautiful Bill Act that I think makes a lot of sense to dive into. One was a permanent kind of installation of the Tax Cuts and Jobs Act. These were policies that were implemented back in 2017 aimed at reducing tax rates. And what you saw is if the Tax Cuts and Jobs Act had not been extended, tax rates were likely to go higher in early 2026. However, with the One Big Beautiful Bill Act, those Tax Cuts and Jobs Act actually became permanent, and we don't have fears of tax rates going higher in the next year. Now, that was really a continuation of policy that we already knew. There were a couple interesting new impacts, though, that came that we think are actually poised to benefit consumers positively. One of those was no new tip or no taxes on tips or overtime pay for qualifying workers, right? Those workers that are kind of service industry oriented or maybe work overtime and are paid hourly. And also the ability to deduct new car loan interest. So you go out and you buy a new car, something that is less than 10,000 miles and never been titled. You now have the ability to deduct that interest similar to how you could deduct mortgage interest in the past. Now, one thing that was surprising that had been forecasted, before the One Big Beautiful Bill Act was passed into law is that there was thinking there would be changes on Social Security taxes, that the tax laws around how you get paid and taxed on Social Security would change. What we saw was not really a change to Social Security tax, but a new deduction for seniors that are over 65 years or older by the end of the tax year, which now allows them to deduct roughly $6,000 for an individual filer or $12,000 for a married couple. What that is supposed to do is deduct limit your overall taxable income to where you will hopefully get to pay less in taxes and keep more of that money in your pocket. Now, most notably for high income tax states, think California, New York, Maryland, New Jersey, what you saw that was, we think, beneficial was an increase to the state and local tax deductions. Previously, you could use $10,000 of state taxes toward writing down your federal income tax. Now that's up to $40,000. So a meaningful way to keep less or keep more money in your pocket by way of paying less federal taxes. Now, of course, all of these comments are concerned around or revolve around what your income is as a household. And before you make any big tax implications or tax decisions, you certainly want to check with your advisor or your accountant to make sure that these deductions or these new kind of tax windfalls can be applicable to you and your specific status. Now, there was a few impacts from the One Big Beautiful Bill Act that I want to address that we might not look at as positive as the tax breaks that the kind of average American is going to experience. One of those is reduced federal spending, mainly through SNAP, or what we call kind of food stamps, as well as Medicaid spending or healthcare spending for those lower income Americans. What we think that this does is we don't have enough data to really have a forecast on what this looks like 3, 5, 10 years in the future. But at the margin, we could see this growing the national debt just by way of tax cuts going into place now, less revenue coming in, and spending cuts taking place further in the future to where you don't really feel that impact of spending cuts yet today. We do think that that could increase the federal deficit, at the margin, and over time could keep interest rates a little bit higher than what we've experienced over these last 10 or 15 years when interest rates were essentially near zero for all intensive purposes. So that's a little bit on kind of the One Big Beautiful Bill Act and its implications to you and I. What's been all over the headlines as well, and kind of what I previously alluded to, was tariffs. Now, tariffs were essentially looked as this boogeyman to Wall Street because historically what they've been are demand destroyers. Right? What they do is they charge a price for any good that you import from abroad into the US, which increases the price of that good. What that means is that less and less consumers are likely willing to pay up for that good, which means less consumer spending, less money going around in the economy, and at the end of the day, slower growth. Now, that slower growth, importantly, could come amid higher prices, which is a worry for markets. The good thing that we've seen here domestically is that we don't expect either one of these things to get out of hand, right? We do see inflation ticking up modestly. However, we see it moderating again next year. What that means is that prices will likely go up in the back half or the back quarter of this year and into next year, but we don't think that that's going to persist. We think that's actually going to be able to say, hey, prices went up to adjust for tariffs, but now because there's not new tariffs coming on, you're actually able to see prices start to level out. I want to say first and foremost, we don't expect them to go lower. We don't expect inflation to be negative, but we do expect it to be closer to 2%, which is really the Fed's goal and their measure of a healthy price growth in the economy. Now, one of the things that we've shown on this slide is that tariffs are not just an impact to us here as the importer of those goods, they can also be an impact to exporters of those goods. We looked at the European Union or Europe here as an example, and what you can see is because of the increased prices that importers might have to pay, those exporters, the folks that are selling us goods and shipping them over here, could actually be a little bit weaker, which could hamper growth abroad. So all in to say, we do see growth slowing around the world, but the kind of silver lining in that is we don't see it going negative and we don't see it slowing all that badly. We also, on the flip side, see inflation going higher, but don't see it going meaningfully higher to where we really need to worry about prices continuously spiraling higher and higher. Now, one of the reasons that the market was able to kind of climb higher throughout Q3 compared to what it did in Q1 and early parts of Q2 is that it looked at tariffs and said, oh, this is really an industry by industry, sector by sector situation where not every part of the economy is going to be affected the same way. So on this slide, what we're showing on the left-hand side is really industries here domestically that might not feel the same impact of tariffs that others that aren't shown on this slide could. On the right-hand side, we show the One Big Beautiful Bill Act and kind of a similar process, and I'll dive into that here momentarily. On the tariff side of the equation, though, if you think about what makes up the United States economy, what drives our growth, it's not really goods, it's not production, right? We don't have the same manufacturing base as we did 20 to 30 years ago. What we do have is a sprawling services economy, which makes up somewhere between 70 and 80% of our GDP any given year. What you can see, a few of the kind of industries or sectors listed on the slide, such as commercial banks, electric utilities, architectural design, and software services, really don't rely on imports from abroad to run their businesses. They run that over the cloud and they run that via the internet, where they don't have to be worried about importing these tangible goods. They're going to have a higher price to them. They're worried about, what am I doing here domestically and who can I serve domestically, right? We don't see tariffs impacting them the same way that an importing retailer could see. Similarly, there are certainly industries across our country that bank on importers or exporters to really get their goods from China, Europe, or anywhere else in between. But there's also a lot of industries that source a lot of their products or services here domestically. Automotive retail, for instance, is a great example, as is biotech. A lot of those kind of manufacturing capabilities are here domestically because they're a little bit more nichey than what your average retailer could have out on the market. And what that means is they're not exposed to, again, those same tariffs that are causing prices to go higher. So while we could see an impact of tariffs and moving prices higher, we think it's going to be more on a case by case basis and not in one fell swoop like the financial media has worried about for the better part of this year. Similar on the kind of One Big Beautiful Bill Act side of the equation, there are certainly industries, sectors, and companies who could actually benefit from some of the provisions included in this. We talked about the Tax Cut and Jobs Act, keeping more money in our pockets as consumers. One of the things that it did for corporations was allowed for immediate expensing of R&D, right? R&D is just the cost that it takes a company to go out and manufacture or build a new product. What you've seen historically is that companies couldn't actually expense this until they had proof the product worked, right? If I was going to build a cell phone, I couldn't actually expense the cost of building that cell phone until I gave Kara a call and gave her a quick update over it, right? Now, what you can do is actually expense that through, which means that you don't have to carry that burden on your financial statements and is actually more favorable for the companies over time. So a few places where we think that is really key is industrial and defense contractor companies, right? These are a little bit more asset intensive. They use a little bit more assets than your average company is going to, and they have that tangible good that they are trying to develop. Another, in the example that I just gave, is wireless telecom, but also online retail, wireless infrastructure, interactive media. All of these are industries or sectors that really want to advance technology. They want to advance the way that we interact with each other and the world as a whole. And what this provision allows them to do is keep a lot of that cost off of their financial statements and pass it through. So you get a more true picture of that company or that industry's financial standing over time. What we really think that does is help bring more clarity as investors look at these companies and these industries, which I must say, as we saw from the price charts before, the market likes clarity. It certainly does not like uncertainty. So if we boil up kind of the impacts that we've seen from policy changes through the One Big Beautiful Bill Act, as well as tariff announcements, there are three key things that we want to look at that help us track the impacts of these things at a more aggregate level. That's the labor market, it's inflation, and it's growth. You might have seen the title of the slide, Parts of the Trinity are increasingly flashing yellow. That's because if we look at all three of these factors, we certainly do not see the red light flashing, which would say, hey, growth is slowing, it could go negative, this might be a recessionary environment, right? We certainly don't see that at all. We also don't see the green light flashing right in our faces saying, hey, this is go time, everything is perfect and as it should be, you need to put every ounce that you can to work, right? We see the middle ground where there are certainly opportunities afoot. However, we want to be disciplined in the way that we go about that. So the labor market, for instance, it's been in the news here lately that not as many companies are firing folks, but they're also not hiring as fast as what they were for the last few years. What we see is really a continuation of this topic exactly, where you don't see meaningful weakness in the labor market, right? People get to keep their jobs. However, we might not see the same pace of hiring that we did coming out of COVID for the last 3 years because so many folks lost their jobs and had to get back into work. So we don't see the labor market being maybe as strong as what it's been the last 2 years. We also don't see it spiraling into weakness. The inflation topic that I covered earlier is really the same impact. We see prices going higher here in the very, very near term, but the expectation for continued inflation is actually lower. And again, I really want to emphasize it doesn't mean that prices are going lower. If you do see prices going lower, it's actually a worse thing for the broader economy than what you'd think, even though I certainly, for one, would love to pay a little bit lower prices. You just don't want the kind of demand destruction or slowing economic backdrop that comes with prices going lower. So while we do see them going higher here in the short term, we see that stabilizing into 2026 and moving closer to that Fed 2% target. And then pairing both of these things together really gives you an idea of where economic growth could go. Right now, if we saw from the GDP print last year, economic growth has stayed strong. We don't see any reason that, again, it falls negative, gets way out of balance, and all of a sudden causes a recession. But we also don't see it being as strong in the future as it's really been these last 2 years. Again, we think right around average to slightly below average growth could be a pretty good outlook for the coming 3 to 5 years. So just to put some quick numbers behind this, and this is a lot of numbers on the slide, but I really just want to focus in on that blue bar, is when I say growth kind of being closer to average, which is roughly that 2% number, we see growth being right around 1.5% for this year and next year. On the inflation front, as I mentioned, you could see inflation tick modestly higher by the end of this year. Our forecast here is 3.3% before moving lower next year, getting closer to that 2.5% range. Now, when we talk about growth and inflation, these are typically the two primary drivers of interest rates. So what we've shown here is two different interest rates. The official rate is the rate that you hear CNBC and Bloomberg or the Wall Street Journal talking about all the time. This is the federal funds rate. And when these folks say the Fed is going to lower rates, the Fed is going to raise rates, this is the rate that they're talking about. What we have right now is roughly a 4% Fed funds rate. We see that being closer to 3.5% by year end, the Fed being able to lower rates this year before doing more so next year and moving that closer to 2.5%, right? We got as high as 5.5% back in the kind of heights of 2022, 2023. We think that finally some of that gas comes off the pedal, or that foot comes off the gas a little bit, and you're able to get more comfortably back down to 3 to 2.5%. Long rates here is the 10-year Treasury. The 10-year Treasury has been pretty range bound all year, right around 4% to 4.25%. We could see it staying like that through year end before being able to move a little bit lower next year because inflation moves lower with it. The 10-year Treasury is important because it's essentially the benchmark rate for all the consumer lending products that we know, right? The 30-year mortgage specifically. So what that means is while we might not see much improvement this year into next year, and as inflation slows, we could see interest rates move a little bit lower and help some of those debt costs actually be reduced for consumers across the country. So knowing kind of these factors are at play and knowing the uncertainties out there, what have we seen from the market backdrop? Well, I'm going to cover a little bit on stocks and bonds, but let's start with stocks here. So what you saw this year, because of all the uncertainty that developed in Q1 domestically, was actually international stocks do really, really well. They've led the way through most of the year because clients have said, hey, I made a ton of money in US stocks over the last few years. Now with this uncertainty afoot, maybe I consider my exposures and take a little slice out of the pie and move it to something international. Because the international markets are slightly smaller than what our domestic market is here, any flow out of the US will have a much bigger impact on an international market than it will on our market. That's why you've seen our markets hold in pretty well, but international markets really turn up the heat. You've also seen, and it pains me to say, the exact same story that we've seen for the last 3 years now. Many of you are likely familiar with the Magnificent Seven, which are, if you know them, name them out with me: NVIDIA, Microsoft, Apple, Google, Tesla, Meta, and Amazon. I bring this up because these seven stocks have never made up more of a percent of the index than they have today. If you look at the largest stocks in the S&P 500, roughly 10 stocks, those Magnificent Seven, plus a few other kind of AI halo names, now make up almost 40% of the index. That is concentration unlike we have ever seen before, and they haven't really been a tariff or tax policy story. They've really been this artificial intelligence halo effect that we'll talk about here shortly. But what's really important is that for the last few years, these seven stocks have driven the bulk of the return of the index, and this year has been no different. You see that the Mag 7, just seven stocks in a 502 stock index, have made up roughly half of the returns this year. The stat that I always like to throw out is we really started seeing this happen in 2023, and depending on where you stop the clock throughout 2023, these Mag 7 stocks had made up something like 100 to 105% of the return. So these folks or these cohort of stocks have really seen tremendous pricing power throughout the last few years. Now, what I really want to hone in on is these seven stocks have been so powerful because if we think about this technological inflection point that we sit at, where we've known the internet is what it was or what it is, and now we think we're going to be moving into this artificial intelligence paradigm where everything gets a little bit more efficient, so they say. Well, the Mag 7 have done so well because they're the ones building the infrastructure behind this to make artificial intelligence a reality. I like to say that they're building the roads and the bridges so that AI or the cars and the trucks can kind of cruise on without pause. So what you've seen is these folks have spent a heck of a lot of money the last few years building out these servers, these connectors, again, the roads and the bridges for artificial intelligence. And because of that, they've actually seen their net income go higher and higher. That's because they haven't really felt the impact of all this spending yet. Where they do feel the impact of this spending and what we've started to see turn a little bit is in their free cash flow. Now, free cash flow is nothing more than the discretionary cash that these companies have to return either to their business or to the stakeholders and shareholders of their business. So while we're not certainly calling for the Magnificent Seven dominance to end or severe market concentration to unwind, as some of the economic warning signs flash yellow, again, not red, but not green, we think that it's really disciplined to evaluate portfolio positioning and kind of sizing of these companies to make sure that you're not too overexposed should artificial intelligence not be all it's cut out to be right now in the media, or if it takes longer for these companies to monetize, right? That's why we want to stay really disciplined in the weights that we hold these stocks at, and we certainly don't want them as 40% of our portfolio like the index has today. Now, where do we look from, or where do we find opportunities today, maybe outside of the Magnificent Seven that have driven markets higher for the better part of 3 years now? Well, the good news is there's ample opportunity out there, both in growth equities, value equities, and kind of core equities in between. What we're showing here are just 4 overarching sectors with a few sub-industries that we think could continue to have really strong earnings growth in the face of all the uncertainty that we've seen and continue to support asset valuations today, tomorrow, and for years to come. A few examples of these are financials. So think banks who are benefiting from deregulation and also lower interest rates, as well as industrials as we look to repatriate some of the manufacturing capabilities that we've had abroad historically. Some of these industrial components could be things like machinery, actually bringing back the processes needed to develop goods here, or electrical equipment, which we think is going to be crucial for powering kind of this next generation technology of artificial intelligence. We always like to say that our grid today probably can't handle the power needs that are going to come from artificial intelligence. This is something that we see being kind of a secular growth driver because investments into our electrical grid are going to absolutely have to be there if we want artificial intelligence to be what it's going to be or what it's cut out to be today. You've also seen opportunities across communication services. Again, these are similar to the companies that we spoke about that might not see the same tariff impact. Think interactive media, entertainment, or wireless telecom, where these services will undoubtedly be invaluable today and on a go forward basis, but could also see really strong development because they don't have those same pricing pressures as what companies who are importing goods from elsewhere are going to have. Healthcare continues to be one of our favorite sectors today as well. You can really find strong growth rates in the healthcare space because, one, if artificial intelligence is what it's cut out to be, well, healthcare is some of the most data rich businesses in the entire world. These machines will learn from each other really strongly and be able to provide better outcomes going forward. We also have aging demographics here in the US that make healthcare not just a want, but an absolute necessity going forward if we want to continue to care for our elderly and make sure that we all stay healthy, happy, and live as long as we possibly can. So while there could certainly be uncertainty out there from kind of the tech sector, where we've seen these Mag 7 names dominate, we're certainly seeing areas of opportunity that trade at much more attractive valuations. And then the last two things that I will share on here is really what do we see in the fixed income markets? Well, I talked about how the one big beautiful bill with taxes going lower and spending going lower, but at different times, could lead to a slightly higher deficit and slightly higher yields. But we haven't seen that quite play out today. And what we've actually seen is the opposite of what we saw last year. We've seen the curve steepen, which is really attractive for those banks that we alluded to earlier, but also attractive for fixed income investors who really want that income whenever bonds pay coupons. What you'll see is that the longer the bond is today, think 7, 10, 20 years compared to 1, 2, or 3 years, you're actually able to increase the interest that you're earning, which if you have higher levels of interest coming in, that means you have more portfolio stability. It's not as susceptible to price action from changing interest rates. So what we see is a continued opportunity to buy fixed income bonds, especially as rates could go lower into next year as inflation slows down. And a little bit more of a specific opportunity within fixed income is what we've seen from municipal bonds this year. Municipal bonds are interesting because the One Big Beautiful Bill Act had initially rumored that it was going to take away muni tax exemption to help try to balance the federal budget. This is something that never actually came to fruition, but municipalities didn't want to bet against it, and they issued a ton of debt in the first half of this year. Now, because that never came to fruition, the supply needs or the funding needs of these municipalities were taken care of, but because so much supply came to market, it actually drove yields higher, right? There was a lot coming to market. There wasn't many people willing to buy it. What that meant is these municipalities had to offer increasingly higher yields to make the bonds more attractive. So what you have now is yields are really high. The curve is steep, which means you're getting more interest further out on the curve. And you now have all these funding needs squared away where supply could actually be negative in the back half of this year, which is really supportive of the demand imbalance and in the investor's favor. So putting it all together, we've seen a good bit of changes throughout the year, both from a tax policy and a tariff policy standpoint. We've certainly seen our share of volatility throughout capital markets. However, we think that the future isn't maybe as doom and gloom as some financial media outlets would make you think. There's, the question of what the heck is going on seems to permeate a lot throughout my conversations. But what we're seeing is, again, strong footing, maybe not flashing green, but certainly not flashing red, which we think gives investors an opportunity to reevaluate portfolios, take advantage of spots across the market that are showing these opportunities, and just build these better long-term allocations over time. So, of course, I'm happy to answer any questions, dive deeper into anything we want, but Kara, I'll pass it back over to you.
Okay, so at the bottom of your screen, you have a little bar where there's a Q&A. I know some of you already found it and have asked me some questions, so feel free to drop any additional questions into that Q&A for us. The first one we got is, are we in a bubble?
Are we in a bubble? So it's a great question because many of us may remember kind of back to 1996 to 1999 when we saw the dot-com bubble. What's really interesting about the differences from then and today is that to be a beneficiary of the dot-com bubble, quite literally all you had to do was put .com at the end of your name, regardless if you were actually an internet provider, an internet player, or not. Today, you're not seeing the same effects, right? Everybody that has talked about artificial intelligence certainly has not benefited in the same way as the Magnificent Seven had. But the key driver here is the Magnificent Seven earnings, who we kind of associate this bubble with, have been really, really strong. So that's something we didn't see in the dot-com bubble when the floor fell out, because there, at the end of the day, wasn't as much money going around. The Magnificent Seven are some of the highest quality companies that we've ever seen, which helps us not really think that this is a bubble, but again, makes us want to think we should be disciplined about our position sizes in case something does turn south. So we don't see this popping and being the same fallout that we saw back in 1999, 2000, but it is something that we want to be cautious about going forward.
Okay, thank you. The next one we have is, are tariff prices already baked into the goods yet?
So yes and no. Where you really haven't seen the impact yet is in consumer prices. So there's really two ways of tracking inflation. It's one, what's the inflation for you and I? What are the goods that we buy at the store cost? And then two, what's the inflation for the companies that are bringing these goods in, right? Because tariffs don't necessarily immediately flow through to the consumer. The corporation that's importing and paying those higher prices initially could actually choose to eat some of that increased cost and not pass it through to the consumer. So really what we see, or that hasn't driven consumer inflation yet, is that back in April when these tariffs got announced, the first thing that happened is a ton of companies imported inventory into the US before the tariffs actually went into place. Now, what we want to watch going into the kind of back or into the quarter, end of Q4 this year, is that a lot of that inventory that we imported in ahead of tariffs has now been spent down, and companies are going to have to look at bringing in new inventories. That's why we think that inflation could move a little bit higher as they bring in these new inventories at these higher tariff-induced prices. The big question remains, do they pass all of that through to the consumer, or do they keep some of that for themselves and see costs go a little bit higher on their corporate balance sheets?
All right, thank you. Next one is, do you expect the foreign markets to continue with the best returns?
So I certainly wish I had a crystal ball to see who was going to have the best returns. I think I'd probably work many less years across my life than what I'm planning to now if I did have that crystal ball. One of the things that's interesting, though, that we think could be supportive of international equities is that if you've looked over the last few years, earnings growth in the US has been here, foreign earnings growth has been down here. If you look kind of toward the end of next year, analysts are estimating that that converges to a little bit more symmetrical, where both experience strong earnings growth, but we see a tailwind being the US dollar. Again, I keep going back to CNBC and Bloomberg, these financial media outlets, because they've continuously talked about the weakening in the dollar today. We certainly have seen it weaken this year. However, it is still incredibly overvalued compared to where it's been for the last 5 or 10 years. So as the dollar continues to return more toward fair value, that's where we think that international equities could continue to be supported, because if the dollar is going lower, then all of a sudden those foreign currencies or those currencies abroad look increasingly more attractive. So we certainly don't think the international rally is a head fake. It might not mean that we see the same 20 to 30% up year next year, but we don't think it's going away.
All right, thank you. Next is, when are you expecting rate cuts?
So when the Federal Reserve cuts rates, it comes at their Federal Open Market Committee meetings, which happen, I believe, 7 times a year, roughly 6 weeks apart. The Fed has 2 meetings left this year. We expect them to cut rates in both of those. So roughly 25 basis points, or 0.25% in each meeting, which would give us a total of 75 basis points, or 0.75% of cuts for this year. What that means is we see the Fed funds rate, or that official rate for the Fed, sitting closer to 3.5% by the end of the year.
All right, great. And then the last one I'm seeing is you mentioned that the industrials are looking like a good option. What do you think about nuclear when it comes to AI?
So I love this question because on the side from my day job, this is like the stuff that I'm researching because artificial intelligence is just so interesting to me. If you think about the comment that I made around the electrical grid and our inability to support AI compute needs today, well, there's going to have to be an advancement in our energy kind of supply process that allows us to make these compute needs. We don't think that the current electrical grid can support this. We're going to have to look for new ways to innovate or to get electricity into those servers and data centers that really need this compute power. So we think that nuclear is primed to see growth for not just the coming year, but the coming decade. Because if you look at what we see today, roughly 500 to 550 nuclear reactors across the world, we think this could look something closer to 1,000 by the end of 2035. So meaningful investments into nuclear or alternative forms of energy, not because we want to have them, because we are absolutely going to have them if we want to make our artificial intelligence aspirations a reality.
I'm going to follow that up with my own question because
Yeah.
my husband's a nuclear engineer, so I hear a lot about it. Do you think those prices have already been baked into a lot of the nuclear stack?
So yes and no, because if you think about, obviously you've seen nuclear rally tremendously this year. One of the ways that we look at it is just through an ETF proxy, which is essentially an investment vehicle that represents the entire nuclear ecosystem. The returns there have been just amazing this year because a lot of this expectation that we're not just going to need this, we're going to have it, has been pulled forward and baked in. And folks are seeing that this is a reality that we're going to have to invest in. What's interesting though is that it's only based on current deployment assumptions of AI. So if artificial intelligence does show to be much more important than what we think, if it not just answers our questions or is fun to chat with in a chat bot, but actually does tasks for us autonomously, brings efficiency to our lives or the way that we interact with others, well then the compute power is going to be even much more, and nuclear is going to have more of an upside case because of that, right? We think the more that artificial intelligence grows, the more applicable that nuclear is going to be. Right now, it's very applicable because we think AI is going to be very applicable, but we think the tail risk is not to the downside that artificial intelligence is less important than we think. We think the tail risk is to the upside that artificial intelligence is way more important than we think. And that's what's going to be the catalyst for driving nuclear or other forms of alternative energy higher.
All right. Well, that is the last of our questions. I think we might need to do a webinar on AI and nuclear now.
Oh, certainly we have I don't days worth of thoughts. We could run this call until Monday morning and still be sitting here talking about AI and alternative energy.
Oh my goodness. Okay. Well, thank you so much, Will, for joining us, and everybody else who was able to make it today. Thank you so much. We will have this recording up on our YouTube page, and we will send an email out letting everybody know that it's available once it clears compliance. And thank you very much, everybody. Have a good weekend.
Awesome. Thank you, Kara. Have a great
I will.
weekend.